Hey everyone, and welcome to This Explainer. Today, we're diving into something that literally affects almost every single one of us. We are going to unpack and completely decode the hidden traps in traditional Indian savings advice. You know, that classic financial wisdom passed down from parents, uncles, and those trusted family friends. We're going to break it all down using clear, logical steps based entirely on the data. So, let's jump right in.
I want you to just stop and think about this for a second. What if the exact investments you've been told your whole life are incredibly safe are actually mathematically guaranteed to make you poorer over time? Crazy, right? It completely challenges those deeply ingrained societal myths we have about financial safety. Well, today, we're looking directly at the numbers to see exactly why this happens and, more importantly, how you can flip the script.
So here is our roadmap for today. We'll dismantle these money myths across 6 quick sections. 1. The silent wealth killer. 2. Illusion of safe investments. 3. The truth about insurance. 4. Mutual funds and SIPs. 5. The investment loan trap. And finally, 6. Your new financial playbook.
Let's start with Section 1, the silent wealth killer, how inflation secretly drains your savings.
Okay, so the absolutely crucial point to understand right out of the gate is this time frame, roughly 10 years. In India, with our average inflation rates, it takes about a decade for the prices of everyday goods to double. Just think about what that means for your money. If your long-term, so-called safe investments aren't growing fast enough to outpace this 10-year doubling cycle, your returns are basically meaningless. You are literally losing purchasing power every single day.
Let's make this real. Look at this timeline. Back in 1990, a 100 rupees note held immense value. I mean, you could pay a month's school fee or buy a really nice jacket with it. Fast forward to 2015, and a standard street samosa costs around 5 rupees. Today, in 2025, that exact same samosa is 10 rupees. By 2035, it's projected to be 20 rupees. The actual value of your money is constantly shrinking. If someone borrowed 100 rupees from you in 1990 and handed you that exact same 100 rupee bill today, it would be almost worthless.
Moving on to Section 2, the illusion of safe investments, the hidden risks of fixed deposits.
Look, we all get excited when a bank announces a 7% or 8% return on a fixed deposit. It feels like a win. But look at this direct comparison. When you factor in real inflation, which can easily hit up to 10% for your everyday living expenses, those modest FD returns barely keep up. In fact, they often lose out to inflation over time. And keeping your cash totally idle in a 4% savings account, that is so much worse.
Plus, there's a huge catch that most people don't know. It's actually a surprising fact that the government only insures your bank fixed deposits up to 5 lakhs rupees. That's it. If you dump all your life savings into a single, small bank's FD, and that bank suddenly goes under, anything above that 5 lakhs mark is essentially totally unprotected. So piling all your cash into one FD? Not as risk-free as we're led to believe.
Section 3, the truth about insurance, exposing the endowment plan trap.
Our sources are incredibly clear on this. Mixing life insurance with investment savings is just a terrible idea. It's like mixing oil and water. The traditional endowment or money-back plan gives you a meager 4 to 5% return, which, as we just learned, completely loses to inflation, and it pairs it with a very low life cover. Now contrast that with pure term insurance. Term plans offer incredibly high cover, often upwards of 1 crore rupees for a very, very cheap monthly premium. When you mix the two in an endowment plan, you basically get a bad investment and totally inadequate protection for your family.
So you might be wondering, why are these endowment plans pushed so hard by that trusted family friend or your local uncle? Well, brace yourself for this number, 25% to 35%. That is the shocking first-year commission agents make on endowment plans. For every 1 lakh rupiah you hand over in premiums, your agent could be pocketing up to 35,000 rupees right off the bat. Term plans, on the other hand, offer drastically lower commissions, and that is exactly why agents rarely, if ever, even mention them to you.
There's also this massive myth out there that only government insurance is safe. Well, let's look at the actual receipts. This is objective data straight from the IRDAI, the insurance regulator. This table shows the solvency ratio, which is basically how much excess cash a company has lying around to pay out claims, and their claims settlement ratio. Private companies like Bajaj Allianz, Tata AIA, and Max Life are actually outperforming the government giant LIC on these key metrics. The data clearly proves that well-regulated private companies are incredibly secure options.
Section 4. Mutual funds and SIPs, the real engine for wealth generation.
Let's demystify this whole concept. SIP stands for Systematic Investment Plan. It sounds fancy, but it's simply a method of investing a fixed amount regularly into mutual funds. It's entirely automated, which absolutely forces financial discipline, and it lets you utilize the magic of market compounding over time. It's not some scary, high-stakes gamble. It is just a structured, healthy financial habit.
So where does your money actually go? Well, there are three main types of mutual funds tailored to your personal risk appetite. First, equity funds. These invest directly in the stock market, meaning higher risk but higher potential return. Next, debt funds. These invest in government or corporate bonds, making them much lower risk. Honestly, they act as a fantastic alternative to FDs. And finally, hybrid funds. These give you a nice balanced mix of both equity and debt.
Now, let's say you are absolutely terrified of pure stock market volatility. Totally understandable. Notice the hybrid approach right here, specifically a balanced savings fund. By putting 70% of your money into stable debt funds and just 30% into growth-oriented equity funds, you build an incredibly stable safety net. It still beats inflation, but it won't give you sleepless nights when the market dips.
Now check this out. This is the staggering power of compounding at work. If you start an SIP of just $10,000 a month, obviously at year 0, you start with nothing. By year 10, you're seeing some moderate, really steady growth. But look at year 20. Assuming historical average market returns, that disciplined $10,000 a month snowballs into a massive corpus of around 1 crore. I mean, wow. This right here is the real engine of wealth generation.
And the best part? Anyone can do this right from their couch using a smartphone. It's just 3 simple steps. First, open a demat and trading account. Second, do a little bit of research and select your preferred mutual fund. And third, set up an auto-pay mandate. You can literally start with as little as $500 a month. Once that auto-pay is locked in, the money invests automatically every single month. You don't have to lift a finger.
Section 5. The Investment Loan Trap. Why borrowing to invest is a complete disaster.
Our sources strongly warn against this really dangerous trend we're seeing right now, taking out personal bank loans to make massive lump sum investments in the stock market. There is an incredibly powerful quote from financial educator Anurag Singh, "Eat salt and roti, but don't take a loan." It's such deeply empathetic advice. It really highlights the severe psychological toll and the long-term danger of falling into debt, even if you are totally convinced you can beat the market.
Think about it. Taking a loan creates what we call EMI tension. You're dealing with constant stress, the terrifying risk of defaulting and losing your assets. And get this, if your investment actually does make a profit, the government hits you with heavy long-term capital gains taxes anyway. On the flip side, we have SIP piece. It's flexible, it's auto-deducted, you can pause it if you hit a rough patch like losing a job, and it works perfectly within your actual current income limits.
And finally, Section 6, your new financial playbook, the clear path to financial freedom.
So let's bring it all together. Here is your clean, optimal wealth formula. Number 1, completely separate your insurance from your investments. Buy pure term insurance for massive life cover at a super low cost. Number 2, buy health insurance to protect your hard-earned savings from sudden medical emergencies. Number 3, invest your actual savings systematically using SIPs and mutual funds. And number 4, avoid mixing them. Avoid endowment plans and absolutely avoid investment loans entirely.
I'm going to leave you with this final provocative thought. Based on all the hard data we've walked through today, are you ready to stop funding your agent's dreams with those massive commissions and start taking logical control to fund your own future? The numbers are crystal clear, the steps are surprisingly simple, and the choice is entirely yours. Thank you so much for joining me on this explainer, and keep learning.